Well, I'll introduce Dr. Delansky first, he's insisted I always call him Bernie, but to me, he'll always be Dr. Delansky, who I've literally known for 27 years, and I would describe him as an absolute gentleman. And although he's not practicing wet finger dentistry right now, he did for many, many years to an extremely high level. And then Bernie, you've served on many boards over the years and have a broad base in organized dentistry. And your main focus now is working at Tier 3, I would say.
Yes.
And you're lucky to work with your son-in-law, Neil, who a fellow Montrealer, and Neil's been at it for 7 years. And my understanding is, once you've got 5 years under your belt, you kind of know what you're doing. I'd say, all of us sort of seasoned people would probably agree the first 5 years, you're kind of, hoping no one realizes that you don't know too much. And 5 years on, you sort of get a little bit more seasoned. The way I would describe Neil, and I haven't had as long a relationship with him, but he's just a solid guy and very, very street smart. And when I use the term street smart, it's hard not to jump into a good friend and an extremely important colleague of mine, or I should say professional acquaintance of mine is Harold Fetter. Harold's been my business lawyer since day one. And as much as he is a nice guy and a pleasure to deal with, from a professional standpoint, one of the things I learned early on is he's definitely got a mean streak in him when you play hockey against him. So you don't want to wind up in the corners with Harold Fetter in a bad mood. So, my name is Cameron Jones. I normally wouldn't introduce myself because we just have people in Ottawa, but Sean was mentioning that we have people from Newfoundland all the way to Victoria. So welcome everybody. I'm a periodontist in Ottawa. I'm very fortunate. I'm one of 7 perios. We have 3 oral surgeons in our group. One fellow's a little bit more seasoned and helps out with our radiology clinic, I should say, our CT clinic with our radiologist, Daniel Turgeon out of Montreal. We also have a sleep and TMD department. And we're very fortunate that we have 3 MDs who provided our sedation for us. I was debating about not thanking all the first line workers, but it reminds me of the 3 MDs that we have here are frontline workers. They're helping out in the hospitals. 2 of the 3, their wives also work at the hospitals as MDs, and one of the fellows' wives is a nurse. So, Sean, we're going to get you to add a link when you send out the continuing ed credits tomorrow, if you would please, to all of our websites if possible with the CE.
For sure.
If that would work. And I promised everybody it would happen by tomorrow morning, but I know there's currently over 600 people, so that might take a little while. So we're now in our 8th week of shutdown, and so it was 30 years ago that I graduated from dental school. I've been through lots of stuff. When I first graduated in 90, we were, sort of just hearing about HIV, going to AIDS, and I've been through, economic upheaval at times where, and we'll touch on this later, but in 08, when, the TSX sort of was cut in half, it went from 17 or 15,000, I think it was, down to around 7,000 and change. I'm sure the bankers and stuff will correct me on that soon, but been through high tech boom and bust, and been through SARS and H1N1, but nothing seems to have been quite as dramatic a change as what we're seeing here. Bernie reminded me to just to let everybody know that 3 of the provinces have kind of opened up a little bit and gone back to practice in a limited fashion. When I look at the regulations, I don't see that's a lot different than what we're doing here in Ontario, where it's emergency and urgent care. But that's not what we're here to talk about today. What we're here to talk about today is what this pandemic has done to appraisals and really the value of practices. So this question actually could be for anyone, Harold, Bernie, or Neil. Harold, when do you think an appraisal should actually be done?
I think, like most decisions in life, planning to sell your practice is one that you want to prepare for and start the process as much in advance as you could. I think we all, think of 5 years as a good barometer in terms of when you might want to start thinking about it. And the reasons are really twofold. I divide them between the commercial and tax in terms of planning. So on the commercial side, and Bernie and Neil can speak to this, if you get the appraisal done sooner rather than later, you have an opportunity to assess what are the value drivers in your practice and what are the value hindrances in your practice. And from a legal standpoint, I'm thinking of leases, employee contracts or lacks thereof, and what do your metrics look like against the average, and how can you drive those up? So those would be some of the commercial issues that you want to identify early in the process. From a tax standpoint, you want to make sure that you're prepared to take advantage of the capital gains exemption. And with good planning, you can, if the value of your practice is there, you can multiply that exemption among family members. And you need corporate and tax planning in order to make that happen. And you want to identify whether your corporation qualifies, and that involves an assessment of the value of the practice against the investment assets you may be accumulating in your professional corporation. And there are 2-year time limits where you have to be ready. And if you're off target within those 2 years, you have to wait. And I have had people come to me and their corporation is not eligible for the capital gains exemption, and they're forced to wait to make a sale or to make a sale at less than optimal tax benefits. So preparedness, I think, is key for all of those reasons, and I think 5 years is a good starting point.
I would just add to that let's look for a moment at what an appraisal is, or what an appraisal should be, and put it in the context that when you decide to actually sell your practice, it's usually for lifestyle reasons. It's a great lifestyle decision, but it's a really bad financial decision, because no matter how much money you get for your practice, that capital is not going to give you the return that it gives you when it's invested in your practice. So put it in that context. But as Harold said, a good appraisal is going to tell you the strengths and weaknesses of a practice. And if you're an owner, you need enough time to act on that if you want to make changes. A lot of our clients decide they're happy with the price, they're happy with the way things are, and they're just going to continue on as they are. Others say, great, now that you've told me I can do this, that, and the other thing on my hygiene program, I'm going to do it. I'm going to make my practice worth more. So the more time you have, the more opportunity you have to make those changes if you wish to.
Neil, maybe you could sort of touch on, if you don't mind. Thank you, Bernie, by the way. Neil, maybe you could touch on the different types of appraisals that are available. I know, if you looked at a full appraisal where people are looking at equipment as compared to maybe just a financial appraisal, if you wouldn't mind just giving a bit of a description on the different types that are available and when people would do one versus the other.
Sure, thanks, Cam. For tier 3, we offer 3 different levels of appraisal. When you're ready to sell, you and the banks and the buyers will require a full appraisal, which includes the full inventory of the hard assets, the equipment, the leaseholds, and any other factors that the buyers and lenders might need. And the other side is we can provide the same appraisal without doing those physical inventories, so that you have all the tools to plan for the eventual retirement. Like Harold mentioned, if you're 5 years out or 3 years out and there's things that you can fix or can get fixed prior to sale, then that would, you don't need the physical assets or the leaseholds inventoried for those purposes. So that's, as you mentioned, just the financial or income valuation. And the third is, like Harold said as well, the planning piece. We do just a quick analysis of the numbers to come up with a value so that corporations can be frozen at a value. And Harold touched on that for the planning purposes. So there's 3 levels of appraisals. They all come with different prices. Obviously, the full appraisal is more expensive, but definitely reach out to us and we can dive into the details of which appraisal suits your purposes at your time that you're contacting us.
Silly question for you, but are appraisals being done right now? Or are you actually seeing people request appraisals? I can't imagine you're doing a full appraisal where you go in and look at the office at this point, but maybe you are because there's no patients there. But are you guys doing partial appraisals at this point, or?
Yeah, so we're doing what we call the income valuation. We can pull all the patient numbers and all the numbers from the computer systems. We can get all the information we need from the leases and everything we need other than, like you said, the physical assets, the leaseholds, which we can add on afterwards, after the restrictions are lifted and we can enter back into practices and safely and inventory the equipment. So definitely we do have at least couple of handful of appraisals that have either been sparked because of COVID or have been underway just prior to COVID. So yeah, the answer to your question is yes. We are open for business and we continue to do appraisals throughout this time.
What's the typical time frame that an appraisal would take to do?
So long as we can collect all the information and you get it to us fairly quickly. Anywhere between 3 to 5 weeks is usually the timeline. We always aim to get it sooner, but the analysis is quite in depth, and 3 to 5 weeks is a typical time frame.
So it's typically 3 to 5 weeks. Bernie, what this could be Bernie or Harold. What are the appraisals usually based on? Is it just purely numbers? Is it purely a multiple of EBITDA? And maybe explain what EBITDA is, or is it, certainly the actual facility itself will have a difference, and patient flow, location. But what are the core factors that you base appraisals on typically?
Okay, let's do a very quick course on appraisals. Most dentists I talk to, and probably all of you talk to, seem to talk in terms of percentage of gross. I think my practice is worth 110% of gross. I think I sold my practice for 123%. That's more of a rule of thumb than a way to really value a practice or any other business. In fact, there are 3 valid approaches for valuing any business or property. Very quickly, they are the comparable method. That's where the appraiser researches what similar properties or businesses have sold for recently, does a comparison, and puts a price on it. That's usually used mostly for real estate, although there is one company in the dental field that does use that methodology. But it does take a lot of adjustment. I've been doing this for 20 years. I've yet to find 2 dental practices that are truly comparable. On the second one, or method, is asset-based appraisals. Each of the assets of the business are valued, as Neil mentioned, the hard assets, equipment, hardware, software, leaseholds, and then some sort of formula or filtering system is used to put a value on the goodwill. And the methodology may or may not be transparent. The third way, and the methodology that Tier 3 uses, is a discounted future cash flow or earnings multiple approach. This, in fact, is the basis on which the great majority of businesses are bought and sold, as it is the most transparent method. If any of you out there bother to read the financial pages, you'll read that XYZ widget sold for 5 times EBITDA or 5 times earnings. EBITDA is a accounting acronym for earnings before income taxes, depreciation, and amortization. In plain English, it's your bottom line, it's your profit. And in the case of a dental practice, part of the expenses are going to be to pay the dentist. Most dentists don't consider their own draw, their own pay as part of their expenses, but a buyer is, because the buyer needs something to live on. The bank wants something for the buyer to live on. And if it's a corporation that's buying, they're going to have to pay somebody usually around 40% to work in the practice. So that is a real expense. And the other expenses are normalized. That is to say, they're brought down to a level that is realistic rather than a level that's usually used for maximum tax deductibility. So with all those adjustments, we get the earnings, the EBITDA, the bottom line, and then we apply a multiple. What that means is when you're selling a lot of practices, as we do, we're aware of what practices are selling for. And we will apply a multiple, usually in Canada right now. If we looked across the country, most practices are selling for somewhere between 4 and 6 times that bottom line. That was before COVID, and at some point, I'm sure you're going to ask us about post-COVID, so I'll wait for that. But up until March 15th, that was the range. Problematic practices may have sold for less, and we certainly have sold premium or investment grade practices for considerably more. But that's the general range.
So I'm not even going to ask you what the impact that the facility will have on evaluations right now, because I don't know that we even know what we're going to have as far as facility goes. And there's a bunch of people have reached out to me that they're worried that they don't have closed rooms and doors and sealed, and what the HVAC will look like. So I'm sure that'll have an impact on evaluations as well. Do you have a sense, Bernie or Neil, what the pandemic has actually done to evaluations, or is it too early to say? Like, what would the multiple be now in your best guess?
It's a bit of a crystal ball gazing question, and right now there's so much we don't know. The crystal ball is a little cloudy, but I think we can look at what's happened in the past and some fundamental laws of economics and draw some conclusion. Certainly the past few years have definitely seen increasing practice values right across the country. And we've seen earnings multiples in the range, I said, of 4 to 6 times. But look, Economics 101 says that the price of anything in a free market is eventually determined by supply and demand. Supply is tricky, but after the 2008, 2009 recession that you referred to, Cam, we actually saw the supply of dental practices go down. A lot of dentists had their retirement plans delayed because of the market. And that shortage of supply is actually what started the climb in prices that we've seen. Will that happen after COVID? It's hard to say. I think a lot of dentists will have been damaged both by what's happened in the market and the weeks that they've gone by without any production and expenses. So on the supply side, I would venture to say that probably what I just said balanced against the fed up factor. I don't want to practice anymore. It should. I would think it should stay about the same. The demand side is really interesting because I'm hearing from many younger dentists that the uncertainty and the probable slowdown of available work for associates after reopening makes a lot of them think much more seriously that if this ever happens again, I want to be a practice owner. I don't want to be affected by it and not be able to find work. Also, interest rates are down and are likely to stay down or go lower rather than go higher. That drives up demand. So overall, I think the supply-demand imbalance that we saw that caused the seller's market going into this is still going to be there. It might be slightly less. So we may, and I emphasize the may, see lower multiples. The one thing that is definitely we can say with certainty going to change is it's a multiple of the bottom line. Bottom lines are going to be affected. We're going to have added expense of PPE.
Sorry, Bernie, I think you cut out there a little bit.
Okay, I said the bottom line is definitely going to be affected. So prices.
Sean, are you able to hear Bernie?
Yep.
I am. Yeah.
Okay.
Okay, can Neil, can you hear me?
Yeah.
Okay.
Sorry, guys.
You're good.
So the bottom line is going to be affected by the increased cost of PPE and the fact that all the provinces have opened and are opening, and I've been following what's happening in the US. You're going to see decreased production. So lower profits will definitely mean lower prices until the production and the costs of PPE can be covered by pricing. Then we will for a period see lower prices.
It's funny. One of the people asked me, but it started with "be honest," and I always get a bit of a chuckle with that because I always try and be honest. But why are DSOs or corporate, dental companies doing webinars very clearly stating that values are going to go down, and why are Tier 3 and ROI saying that nothing's going to change or it may go up? And I don't think anyone's trying to be dishonest. I just don't think people know until it shakes itself out. Does anybody want to weigh in on that? Or I've certainly know people in the DSO industry with Dental Corp and 123 and Mark McCullough's group here in Ottawa, and they're great people. I wouldn't as are you and the people at ROI. I don't think anyone's trying to pull the wool over or be dishonest. I just don't know that people have a solid answer.
Let me jump in maybe because I have no skin in the game. I'm not a evaluator. I don't work for a DSO, but I see both sides. So this may be the lawyer's answer. It's a gray area, and I see validity in both points of view. And I think Bernie touched on it. And I think in large part it's a question of timing. If you're looking for someone to determine value today, where you're factoring in all of the uncertainty, I think the most basic principle of economics, aside from supply and demand, is uncertainty does not add value. It takes away value. So where you're in a period of uncertainty, and this word is overused in the context of the pandemic, this is unprecedented. So we can look back to 2008, we can look back to prior periods, but it's hard to know just how this pandemic is going to impact the practice of dentistry going forward and supply and demand. So if you're asking someone to commit today to a purchase price, that's going to be less than it was 2-3 months ago. If a vendor is looking to sell today and enter into an agreement today with a commitment today, that value will be less than it might have been 2 months ago, and that's where the DSOs are coming from. If you're talking about what's going to be the impact on the value a year from now, when we have a little bit more certainty, hopefully, when we can determine the impact on the expense side, when we can determine the impact of restrictions on production on the revenue side, and therefore on the overall EBITDA, we may come back with the supply and demand forces to the values that we were a couple of months ago. But I think it's a question of timing. So I think in a sense, they're both right. And it really is a matter of when are you looking to get a commitment from a buyer to buy your practice. And I ask people the simple question when they approach me on this topic. Would you pay the same thing today as you would for your practice as you would have a month or two ago? And the answer I think is no. Would you pay the same a year from now? The answer very well may be yes, and it may even be worth more. And that's where the uncertainty comes in.
And just to add to that, Cam, you mentioned the DSOs. I think they're saying what they're seeing, and with maybe one exception, I haven't seen them trying to take advantage of this situation. But my advice to anybody out there, either a buyer or a seller, would reinforce what Harold said. Times of uncertainty are never the best time to sell. They are often the best time to buy. If you need to sell a practice right now because of a lease issue or a health issue or a fed up issue, you're going to get a fair price. You probably won't get what you would have gotten if we closed it in February, but you're still going to get a fair price. People forget that one of the great advantages of a buyer's market, and I do think, I don't know if Harold agrees, I do think we're going to still have a seller's market, rather. We're still going to have a seller's market during this period. It's just not going to be as strong. One of the great advantages as a seller is you get options. You should never deal with just one person if you want to get the best array of choices that are available to you in a seller's market. Don't forget that. That fundamentally doesn't change.
So actually, Bernie, Neil, why do people, when and why do people normally sell? Your fed up factor right now, you're right. Some of the questions that people sent out were, our older dentists, I think they were looking right at me when they said it, but our older dentists tired and beaten up and want to throw in the towel? Or, what stages of life are dentists typically selling?
If you'd asked me that question a few years ago, most of our clients were retiring dentists, but that age is moving down steadily. We sell practices for, I would say, anybody from the age of 40 right up until almost 80 in one particular province. The fact is that, as I said earlier, it's becoming more of a lifestyle decision. Probably the thing I hear most often from clients is, Bernie, I still love doing dentistry, but when am I fed up with running a practice, with owning a practice, with trying to find an assistant, with trying to find a receptionist, with all the new infection control stuff, and that's only going to get compounded in the next few weeks. That's what I hear. And they're looking for their options to keep practicing dentistry, but no longer be an owner. Listen, that's the biggest sales pitch that the DSOs have. And it works because it's true. That's what's out there.
And
but again,
it's also what we're
your options.
It's what we're trained to do, right? We're trained to do dentistry. It's what we often host these dinners for doctors or dentists, and we'll have anywhere between 5 to 10 people at a table, or dentists at a table, and no one ever talks about the hard root canal or gum surgery that they did. It's all about staffing and business issues. So you could certainly, it's not your field of expertise how you get a bit worn out, and certainly it is an attraction for selling, or like you say, selling to the DSOs. Neil, did you want to weigh in on that, or Harold, did you want to weigh in on timing of transitions that you typically see?
Yeah, I'll just say one thing about it is, regardless of what age someone is transitioning their business, it's a lifestyle decision. Whether you're 40 years old and you want to spend more time with your kids or the cottage, and you want to just come in, do your dentistry and walk out and own a piece, then one purchaser is more appealing to you versus selling in your latter years, where you want to sell and walk out the door as soon as possible. That there's a different buyer for that. So the answer to your question is there's a range, and it's almost always a lifestyle decision.
Yeah, I would certainly echo the sentiments from Neil and Bernie. The only thing I would add is there's also an element of wanting to monetize your asset and take the risk off the table of what the market might be in 2, 3, or 4 or 5 years. And again, I think that's when the different options in terms of DSOs versus a private sale versus selling to an associate, where those factors have to weigh in, where you've reached a point where you want to know with some certainty what this asset is going to be worth. And so you look to the market, you look to what's out there, and you say, what can I do now that can monetize that asset and take the risk off the table? I don't disagree with Bernie's point that in terms of an asset and an income producing asset, ownership of a dental practice is worth more than ownership of the proceeds of sale of a dental practice. But again, that comes with the uncertainty of what it's going to be worth in 2, 3, 4, or 5 years, and what is a person's health going to be like, what are other factors that may impact on their practice going to come into play. So I think there's an element, and I think it's happening earlier in life than it was before, to Bernie's point, of taking the risk off the table and looking to monetize the asset.
So Harold, I know you've got a finance degree and a love of numbers, so I'll throw this one at you, but is it usually a good idea or a good business decision, cash flow decision, to sell your practice?
I'll say never, and then I'll walk it back a little bit. So never, all things being equal, never, in the sense, like I said, that owning your practice and the profit margins that the practice of dentistry generates, I think are very difficult, if not impossible, to match in the investment market. I think that's just the reality. However, continuing to own the asset, like I said, comes with some risk. So what will the market be in 3 or 5 years? If you plan to hold it for 5 years, maybe there will be a glut of supply, maybe there'll be a fall in demand, and those forces will drive values down, may drive the EBITDA multiples down. We don't know. I think the trend has been up, but again, if you have some aversion to risk and you want to know for certainty it's reached a point where you're comfortable with the value, you know you can maintain the quality of your lifestyle with whatever that is worth today, and you take the risk off the table. So generally, you're better off being an owner and earning those profits yourself, but you remove risk by selling. And I think that's the balancing act that people go through in making the decision on timing, assuming that their health is such that they can keep going.
Cam, I would just add something about the risk. When you sell, especially to a DSO, they all have different business models. And some of them have more post-sale risk involved than others. And if you're selling for lifestyle reasons, I think I can extrapolate what Harold said correctly. If you're selling for those reasons, you really want to lock out your risk and enjoy just practicing dentistry. And when I mentioned before about options, amongst the DSOs, there are different options, different business models, and different levels of risk that you are going to take on even after you sell. And you should be very aware of those and have good advisors who will make you aware of those, because they will affect your lifestyle decision post-sale.
And I think yes, absolutely, and not just unique to the DSOs, right? You'll often hear of smaller offices being sold to an associate, and maybe it's a great transition, or it may not be as well, right? So I think it's not unique to the DSOs, I would say. Are you guys still seeing transactions happening right now, or is it just everything that was kind of in the queue?
We are actually, Tier 3 is actually selling practices right now. Neil can give you some numbers which will help illustrate how uncertainty affects the market. But yes, we are seeing transactions, and I think Harold can speak to a transaction that he's actually done during this period. What we're seeing is people are negotiating, people are making deals, but for the most part, we haven't seen deals closing because the banks won't release funds until people are back at work, which is very good of the banks. They don't want you to incur debt when you have no way of paying it back. So the answer is yes, but maybe Neil, you could illustrate a little bit about a sale that we have in progress right now and how the numbers have been affected by this COVID period.
Yeah, so Tier 3 has a listing in Oshawa that went live during or after COVID put restrictions on dental practices. The client decided to still go ahead with listing the practice. And what we did was we performed virtual tours. And as some of you on this call will know that you receive emails when we have a live listing go out. And from those live listings, we had over 300 inquiries still. Almost 100 people received the appraisal. And we booked 11 virtual showings for people who were still interested during these times to see the practice but not go into it. And interestingly enough, that number would have probably been double had it been, let's say, a month prior. And we did receive 2 LOIs and 5 others that said, had we not been in these uncertain times, they would have also submitted an LOI. So it's not that things have stopped completely. We still received 2 LOIs, and one individual who was very serious about this practice even mentioned that he felt it was a very good time to make this offer because he felt that there was less competition in these uncertain times, and he really wanted this practice, so he went ahead and submitted a very strong LOI.
And are these people paying cash, or is this are they going to their friendly banker like I do, Dan T at RBC, and saying I need a whole bunch of money?
It's going to be bank financed. However, the likelihood of it closing, these deals don't close overnight. So the likelihood of it closing once the revenues have returned, we're talking LOI stage. So there's still a couple of months of going back and forth and formalizing the deal. So the hope is that once the restrictions have been lifted to the point where dentists can return to practice, that they'll be able to close the deal. So, and quite frankly, the client could have held off and decided to go to market afterwards, but the ball was rolling, so they went ahead with it.
I could share some of my experiences in the last month or so during the COVID era. So one transaction that I was on actually did close with bank financing within the last week, but it's the only one, and there were a number of factors. I think the first is it was an associate principal relationship, and I think was mentioned earlier as a driver of value and a driver of demand. If associates are concerned about the existence of a job, that will incent them to buy practices, and that was the situation here. So that was one factor. And the other factor is the parties came up with a creative solution to address the COVID shutdown period, with the vendor essentially financing the expenses of the practice post-sale during the COVID period. And that included the purchaser's debt servicing as well. So rent, fixed costs, and the purchaser's debt servicing were covered out of the purchase price. And I think with those two factors together, it led to the motivation on both sides to complete a transaction with at full value and with full bank financing. But that was a fairly unique circumstance and the only one of its kind. The DSOs are still active and they're going beyond LOIs. They're signing binding agreements during this period, and values have gone down from where they were before. EBITDA multiples have gone down, but I think each situation is unique, and the DSOs and the vendors are coming up with give and take in terms of what's most important in the deal and finding ways to have a meeting of the minds and complete binding agreements, which will close at various periods once things reopen. I think I would add that for the most part, the risk of the revenue return is on the purchasers, not the vendors. So there's very limited conditions that are being left in these agreements for wiggle room for the buyers to get out. And I think that's part of the attraction. If you have a willing vendor, part of the attraction is that the most of the risk of any further downturn or a slow resumption of full production and full revenue is being borne by the purchasers in exchange for the lower values, I guess is a fair way to put it.
Sure. I mean, a question I keep see coming up here live is, we don't really know what changes we're going to have to make to the physical structure of our practices if we do in fact have to make physical changes. How does that typically affect a purchase price? Is it borne purely by the vendor, or is it or split between the vendor and the purchaser, or is it just negotiated each individual case?
Well, part of the job of a good appraiser is to eliminate one-time expenses. As an example, if I was evaluating your practice, Cam, and in the past year you'd replaced an X-ray head and you had a $6,000 expense, I'm not going to have that affect your bottom line. That's a one-time expense. And that new X-ray head is adding to your productivity. It's going to be the same thing with any changes that are necessitated by EBITDA. We've been dealing with this over the last year and a half, especially in Ontario, with the IPAC changes, the infection control changes in Ontario. A lot of dentists and dental offices have had to upgrade. Those are one-time expenses, and they're usually borne by the practice owner in order to maintain their earnings and get that earnings multiple.
So Bernie, do you mind touching on what it means to normalize the number? And I can't remember if it was you or Neil who used the term, but it's certainly a term that anyone's had an appraisal done or chatted to an accountant. You often hear the term about the numbers being normalized. And what does that mean exactly?
Probably the easiest way to answer it is to give an example. Let's say I look at your financial statement and you have a $20,000 expense for insurance. Well, I know that for the typical dental office, triple guard is going to cost somewhere around $2,500. So I'll ask you what the other $17,500 on your expense line for insurance is. And it may be that you have a universal life policy, you have other policies that you are quite legitimately running through your professional corporation. But that isn't really a cost of running your practice. So I'm going to plug in $2,500 as the insurance expense, not your $20,000. Another typical one is I'll look at your salary line and 35% of your gross is salaries. And I know that in Ontario, that should be somewhere around 27%. So I'll ask you about it. And again, quite legitimately, you're paying your spouse for work that your spouse is actually doing in your office. Well, the new owner is not going to pay your spouse. So I'm going to add that back. That's what normalizing is.
Would the new owner pay my kids though? Would that? No, okay.
The other thing.
If you can get the new owner to pay your spouse, you're a good negotiator.
Yeah.
The other thing, Cam, that would, like Bernie was talking about, the IPAC regulations. Let's say in 2019 you had to spend $50,000 changing some of your IPAC cassettes, or changing a sterilizer, or the sterilization center itself. That's not an ongoing $50,000 expense year over year. So we would add that back to your cash flow on a go-forward basis.
Good question.
I think that's a good segue, actually. There was a question about how are changes due to COVID one time. And I think, as Neil just mentioned, you have to look at the particular expense. If there's an investment in infrastructure within your practice, that's a one-time. If every treatment has additional costs for PPE or whatever it is that needs to be added in, that would be an ongoing annual expense that would have to be deducted from your revenue in determining your EBITDA before you start applying the multiple. So I think you have to look at each expense that may be arising out of the post-COVID restrictions and analyze, is it something that you spend once, or is it something that's just part of your everyday, day-to-day practice, which is going to be recurring?
And the new PPE may add to ongoing expenses, so that we'll
Correct.
see what we have to do.
Exactly.
We've already seen that. We went to what are now called universal precautions for infection control in the 90s because of HIV.
Yeah.
And at that time, that added to the expense of running a practice. And it took, if I remember correctly, 3 to 5 years, depending on the province and the fee guide, for that to be priced in so that it became earnings neutral for us. I anticipate the same thing's going to have to happen with the PPE that we're going to need post-COVID.
Yeah, I came in when we all wore gloves, but I don't know if you practiced without gloves originally, Bernie, or not, but I don't know how you guys did it if you did.
I did apical surgery I was trained to do apical surgery without gloves. Can you believe it?
I do believe it. Here's one from my good friend, George Karamanokian. I think it's probably geared more towards Harold. To use family members for capital gains exemption, and maybe you can go over what capital gains is too, Harold, if you don't mind. Is it based on the percentage share they own in the PC or DPC, or can you use the maximum exemption for each member irrelevant of the percentage shares they own? And maybe that will, you can touch on why the 2-year minimum planning makes sense as well.
Sure. So capital gains tax 101. So capital gain is what you receive when you sell capital property, such as shares of your dentistry professional corporation, for an amount more than you paid for it. So you have your proceeds of sale for the shares, less the adjusted cost base, which is what you paid for the shares. And in most cases, if you started up the practice from scratch, then your adjusted cost base would be nil or close to it. So your capital gain would be your proceeds of sale. Half of that is brought into your taxable income. And then we have this wonderful tax incentive called the lifetime capital gains exemption, which every Canadian man, woman, child is entitled to over their lifetime. And it's creeping up to, not quite at $900,000 per person, but it's getting there. And so husband, wife, 2 children, times 4, you're looking at $3.5 million of gain that could be sheltered. But it is based on what the person owns, which is a percentage of the practice. So if you've got a $3.5 million practice and all 4 family members own the shares and have for more than 2 years, then you can shelter the whole proceeds of the sale through the capital gains exemption. You also have to analyze the type of share that it is. Before TOSI, which is the income splitting prohibition that the government passed a couple of years ago, people used a certain kind of what would be called preference share or special shares just to income split with family members. And those do not increase in value. So you cannot use the capital gains exemption on those types of shares because there's no growth. They need to have what's called common shares, which are entitled to the residual growing value of the corporation, which is driven by the value of the underlying practice. So to your point, Cameron, in terms of the 2-year wait, you have to hold the shares for 2 years in order to be eligible for the capital gains exemption, and you have to have value. So a person who owns all the shares can't just give the shares to a spouse or child and say, okay, now you have it, and therefore when it's sold, you get to use the capital gains exemption. You have to do what's called a freeze, kind of lock in the current value and allow future growth to accrue to those new shares. So I think we started this with talking about planning and when you want an appraisal and when you want to start thinking about it. This is why you want to start sooner rather than later. And 5 years is an excellent choice to give you the ability to make sure that you can take advantage of this capital gains exemption with as many family members as you can. I will leave the comment with this, because this is a discussion that I've had for decades over this capital gains exemption. If you put the shares in a spouse or child's hands and the shares are sold, the proceeds belong to them. They don't belong to them for a day until they give them all back to you. They belong to them until they decide what they want to do with it. And we're dealing with adult children and spouses. It's up to them. And that point is often lost. And when you're analyzing this between you and CRA, it's an easy choice that you want to involve the family members. But once the sale takes place, and then it's between you and the family member, sometimes that point is lost. And it is very important to keep in mind. And again, it goes back to the point of planning, just to understand exactly where you're going to end up post-sale from an after-tax standpoint and who is going to be entitled to the proceeds.
Okay. Harold, can I just ask you to clarify one point?
Sure.
If I'm not incorporated and I sell my practice, can I incorporate just before the sale and not have to wait the 2 years?
You can. So that's an exception to the general rule. You, as the owner of the practice, as a sole proprietor, can transfer the practice into the corp immediately before the sale and take advantage of the capital gains exemption for you. What you lose is the ability to involve family members. So if you've got a $2-3 million practice and you transfer it in, you're going to be capped at your capital gains exemption, and you cannot involve family members in the multiplication of the exemption. So you're stuck with your own exemption. That's a good point, Bernie, and it is an important exception, and certainly been a part of many of those situations where an unincorporated dentist is probably forced to sell for health reasons or what have you, and we're able to transfer the practice in immediately before the sale and still shield $850,000+ of gain.
In the comments section wrote out that when you're handing out money,
You froze, Cam.
the kids,
Sorry, you just froze there.
turmoil. Somebody wrote down that when you're handing money off to kids, it causes family turmoil. That usually fights start over money.
Well, I can tell you an absolutely true story. I wasn't a dentist, but it was a business owner. And back then, the capital gains exemption was $500,000. 4 family members, convenient sale price of $2 million. So it was a perfect plan. The family received the money tax-free. And I'd had this conversation, the accountant had the conversation, keep in mind, it's your kid's money. And then post-sale, no proceeds were actually distributed, but the $500,000 gain was reported on the tax returns of the 2 adult children, one of whom was on welfare. Well, guess what happens when you have a $500,000 capital gain on your tax return as a welfare recipient? Your welfare is cut off. And the adult child went back to dad and said, like, what are you doing to me? I haven't seen any money and it's my money. And he calls me up, of course, forgetting the 25 times where I told him it's her money. And he says, could you believe my kid? She thinks it's her money. And moral of the story is it is. And so you have to keep that in mind when you're doing your planning. And there may be situations where it's not worth the risk and you decide that you'd rather pay the tax than create the potential family turmoil. And that is something that even as a tax lawyer, I will never dissuade people from following those principles, because I think family comes first, and family harmony certainly comes first ahead of the mighty tax dollar.
It's funny. There are a few, general questions. I think this is probably more for Neil and Bernie, but from people who are currently working as associates, wondering if it's better to set up their own practice from scratch at this point, or would it be better to buy over an existing office? And I think that, probably the answer would be the same now as it would have been a year or two ago. It depends on the cash flow, but you guys are better suited to answer that than I would be.
Okay. Actually, there have been a couple of articles and studies done on that question. Almost all of them have come to the same conclusion, that after 5 years, you have a better return on your investment from paying a fair price for a practice than starting from scratch. I've seen very successful startups from scratch, but don't forget, when you're starting, you need a good location, and good locations in most metropolitan areas of Canada are really getting hard to come by. One of my favorite anecdotes is when I go to an Ottawa Dental Society meeting, I hear complaints about too many dentists in Ottawa, and my standard response is, look, in Ottawa, we're good. We only have 3 on every corner. In Toronto, they have 8 on every corner. There are areas of any city that are growing and you can do a startup. There are many areas of the country, because I know we have people from coast to coast on this, that you definitely can start up and get busy enough to have good cash flow within a reasonable amount of time. But on the average, you're going to be ahead if you buy a practice rather than you start up a practice. And I don't say that because I'm a practice broker. That's what the studies say.
And let me just comment on some of the trends that I'm seeing. I think like in any economic situation, as values go up, people look at other options. So probably in the first 15 years that I was involved in dental practice transactions, I don't know that I saw maybe one client or 2 clients that were looking to start from scratch. But as values went up, I think more and more, and it may be the nature of the individual wanting to flex their entrepreneurial muscles and want to be in control of everything from the beginning. But I'm seeing more of those types looking for good locations and wanting to start from scratch. I don't disagree with Bernie's comment, and the studies are what the studies are. I'm just commenting on the trends where more are starting from scratch, looking for locations and building the practice and the facility in the way that they want. Also see hybrids where, and this is I think more popular in some of the rural areas that may be on the outskirts of metropolitan areas, where you have a vendor and an associate go in to start a new practice on the assumption that the associate is going to buy in a very short period of time and pay probably less than they would if the practice was 10 or 20 years of maturity, but pay more initially to buy and hit the ground running with a steady cash flow that is growing. So I would describe that as somewhat of a hybrid to the usual model, and we're seeing that as well. And I think Neil, Bernie, and I have worked together on those types of transactions. So also seeing that trending. And again, this is all pre-COVID. What COVID is going to do to this is anybody's guess.
Yeah, and just to touch one last time on that, when you're talking about your time frame, Harold, Ottawa was expanding in every direction, and there were a lot of opportunities where strip malls were being put up and new practices were being started. A lot of those opportunities are tapped unless you're willing to go outside the city now. So the startups are fewer and far between, but there are still malls going up in different parts of those developments and subdevelopments. And so you got, like Bernie said, location, location, location.
Yeah. And also there's a spillover. In most metropolitan areas, certainly in Ontario and in other large cities, it's tough to buy a practice. We'll see anywhere from 3 to 15 offers on a good practice. And the people get frustrated and they go out and start on their own. And that's a perfectly valid way of getting your foot in the door.
It's funny, Bernie, you were saying, when you first started, or in Ottawa, there's only 3 dentists per corner, not 8 like in Toronto. But when I first came to Ottawa, there was medical dental buildings where the actual building was full of dentists, and you don't see that model anymore. No one, a lot of the dentists back in the day would almost look down upon the mall dentist and didn't feel it was professional. But I don't think anyone would set up in a medical dental building at this point. They, typically you want to go where there's the, location, right? Parking and patient flow. A little bit different as a specialist. We were, for us, it's more accessibility. But, I think there's an appearance of, per capita being a lot more dentists, but the population has grown. The number of dentists has grown for sure. But I think the spread and the distribution of dentistry has changed as well.
If I could put up a graph, I'd show you a graph that shows that the growth in the population has been twice the growth, the growth in number of dentists has been twice the growth in the population over the last 10 years. I have those numbers.
I don't want to see them.
The other thing, Cam, just to touch on your point, there are some medical dental buildings that are very successful at what's happening is they're consolidating the 30 practices, let's say, that were in the medical dental building down to 5 over time. Specialists such as yourself don't rely on specific walk-in traffic. Nobody's going to the oral surgeon off the street. So it doesn't matter if you stay in the medical professional. So when you're saying that area of occupancy is going away, it's not for specialists, but it is mostly for the GPs.
Well, when we're not busy, we take each other's teeth out. There's enough of us here that we can do that. So
That sounds like fun.
And I have to ask this one because it's from a Perio resident, so I feel a little bit close to heart here. Whether they should start up or purchase, so a referral-based practice. Are you guys seeing in terms of specialty practices, specific Perio, they're a third-year resident, which would be their last year, just to
So you're freezing, Cam.
graduate, wondering if they're up or to practice?
You froze a little bit, but I think I understood the question. We definitely sell specialty practices. We do transition them. Interestingly, based on our experience, probably the specialty that is the most saleable are orthodontists, because more orthodontists graduate than any other specialty. So you have a pretty good buyer pool. And with the properly planned transition, it's a good practice that can be transferred from one specialist to another. And that's true of all specialty practices. The key is the transition, because very quickly in a general practice, we're transitioning the patients. And having sold thousands of general practices, we know that that is a reliable model. In a specialty practice, with the exception of orthodontics, which has a really big or significant retail component, all the other specialties are mostly referral based. And transferring a referral base is an entirely different model and has to be well planned. But yes, you can. We do sell perio practices. We sold endo practices, oral surgery practices. The gold standard, and I mean gold in real money, are general practices. They are the most valuable. But given the oversupply of both general dentists and specialty dentists, specialty practices have value now too.
The typical retention you see of patients when there's a transition from an associate from an owner to an associate buying over, what's the typical retention of?
In a general practice, we see very high retention rates in almost all transitions, well-planned specialty transitions and general practice transitions. When I first started doing this, typically most deals were what I called Friday, Monday deals. The sale closed on Friday, the selling dentist retired over the weekend, and the new dentist started on Monday, and there was very little overlap. That has not been true for the last few years. In order to maximize the transition of patients, the buyer will want you to stay. If it's a corporate buyer, they'll want you to stay as long as possible. And the longer you stay, the better options you're going to have and the better price you're going to have. But even for a single buyer, if the seller stays, the retention rate is very high. We have mostly dental people on this call, but for the average patient, the last thing they want to do is try to find a new doctor or new dentist. It's not something anybody looks forward to. So they're going to try the new owner. And like I say to new owners, look, there are 3 things you got to do the first day you walk into the office. Take a shower, brush your teeth, even though you're going to wear a mask, maybe an N95 now, and don't try to sell the first patient you see $5,000 worth of dentistry. If you do that, you're going to retain your patients.
Yeah, I mean, anecdotally, I have no idea how many transactions I've acted on. I have not once had a retention issue on either side being raised, whether acting for the purchaser or the vendor. And I think the reality in dentistry, maybe more than any other profession, and this is why there's so much value and the goodwill is saleable compared to accountants and lawyers, where it's very much personal, is that people go to a dentist for, we've said it, location. They go because of a relationship with the hygienist, who may be someone that you've worked with for many, many years. And to the extent that the location is staying in place for years to come post sale, and the staff is staying in place for years to come, and the new owner follows Bernie's 3 principles to successful transition, I think for the most part, you're going to get at or near 100% retention. And because these other factors are very important to the dental consumer, and they don't want to find a new place to go get their dental work done. They don't want to worry about parking in a new place. They don't want to meet a new hygienist. And so they're inclined to stay put and give the new owner every opportunity to continue to maintain their business.
Cam, are you still there?
Mm-hmm.
I think so.
I'm still here, but I have to admit the Wi-Fi, for some reason, I don't know why.
I want to kill your video.
I
want to kill your video, Cam, even though it's nice to see you. It draws, I think, a little bit less on the bandwidth.
Harold, any questions?
Harold, do you want to read out a couple of the last questions?
Sure, hang on.
There was one from Dan T that was actually quite good that Bernie and I can address if you want.
If you have it, is it on? Is it on the question?
So Dan T, and I'll say that he's in the banking field. As we look across the sectors and how they respond during this COVID-19 pandemic, can we sort of characterize industries that have retained business activities while some have deferred business disruption, and then others which simply lost revenue, which will not be recuperated? When we look at dentistry, would we characterize the disrupted revenue or deferred or simply lost, or perhaps a combination?
I would say a combination, but mostly deferred. Yes, there are a certain number of routine hygiene checkups and cleanings that are going to be lost revenue, but broken fillings, loose fillings, people who wanted their missing teeth replaced in one way or another, those don't change, and that's deferred. I think one of the great challenges for the post-COVID time frame is going to be that literally tens of thousands of appointments have been canceled during these 7 or 8 weeks. And they're going to continue to be canceled because of reduced schedules when we do go back to work. And much of that is going to be deferred revenue. Dentists will have the opportunity to extend hours, to extend the days that they practice, just playing catch up. And yes, mostly the routine preventive stuff is going to be lost revenue, but the great majority is, I believe, going to be deferred.
The only thing I would add is potentially, at least in the short term, while there's economic repercussions of this, some of the maybe elective cosmetic work that could be part of a revenue base, it may be deferred, it may be lost, but if instead of earning it next year, you're earning it in 5 years, that is deferred in a sense, but it's also lost because of the time value of money. So I think that would be the third element, which will be somewhere in between, where it might be deferred for an extended period of time, and not lost necessarily, but put out until there's a bit of economic recovery from all this in other industries.
Well, I would just add to that it's really a combination of things, because if you've got, for the dentists on the call, an edentulous, a space in your mouth without teeth, you may have been planning an implant before this happened. Now, economically, you can't afford it, so you'll get a partial denture. But you will still want to do something to allow you to chew. So again, that's not a lost revenue. It's not deferred revenue. It's changed revenue.
I think there's 2 more quick questions, and I think to respect everyone's time, we should wrap up. Someone had a question that, is it important for an associate to incorporate planning to buy a practice within 1 to 2 years from now? I'll let Harold touch on that.
Sure. So I think there's 2 aspects to incorporation. The first is as a revenue earner, and we have lots of associates who incorporate. And the basic question is, when making the incorporation decision, it's more complicated than this, but I'll break it down into the most basic terms. Are you making more money than you need to live on? And if the answer to that is yes, then incorporation is a good tax decision, because you can accumulate wealth within the corporation at a better after-tax rate than earning it personally. So that's a decision to be made in terms of or being a revenue earner. In terms of being a purchaser of a practice, the vast majority of practice purchases are done by a corporation buying the shares of the target corporation and then immediately amalgamating. The amalgamation creates a new entity, which has to reapply for an RCDSO certificate of authorization. So there is no advantage to incorporating. So if you're fresh out of school and you're not earning money, and you've asked yourself the question I just gave you about whether you're earning more than you need to live on, and if the answer to that is no, and you stay unincorporated, you could incorporate immediately prior to acquiring the practice, buying through financing lent to your corporation. You amalgamate, and then immediately following the completion of the transaction, you apply for your RCDSO certificate, and away you go. So if the question is just for a purchase, you don't need to buy well in advance. You could incorporate immediately prior to the purchase.
And there's one question, do we do valuations in the same way in terms of multiple of EBITDA? And yes, we do our valuations based on the multiple of EBITDA. And the other one was, do we value specialty practices on the same multiples as general practices? And the answer is no. The specialty practices are at a lower multiple for the most part than the general practices. And there was one more question. How does a neighborhood impact retention of patients? When should the dentist consider moving to the new location? I'm going to say that Sean will share our email addresses. So if we didn't get to your question, or you had a question you didn't want to send us during the webinar, feel free to email us anytime, and we'll be happy to either set up a call or respond to you via email. So Bernie, do you want to take that? How does a neighborhood impact retention of patients? And when should a dentist consider moving to the new location?
I would say that retention of patients is more of a personal thing than a neighborhood thing. If you're buying a practice in a certain neighborhood, you know what you're buying. If you're buying a practice in an upscale neighborhood, those are the patients you're going to treat, and you should be prepared for that. If you're buying a practice in a more middle class or working class neighborhood, you should know what you're buying, and you should be prepared to give that type of dentistry. That's part of your research and part of what you should be basing your offer on. And quite frankly, I think, as both Harold and I have said, retention's very, very high as long as there's a good transition, as long as you know what you're doing and you don't do anything stupid when you come in as the new dentist. If it's well planned and you don't fire your hygienist the first day you're in there, you're going to do well, and you're going to retain your patients. I really don't see neighborhood as being a factor. A quick addendum to what Neil said in regard to lower multiples for specialty practices for the most part. The multiple really represents the risk in buying the practice and the demand for the practice. Those are the two main factors. And because of a longer transition and the need to plan a good transition, most specialty transitions can be more risky, although that can be mitigated. But the main factor is there's a smaller buyer pool for specialty practices, thus less demand, thus usually less or lower multiples.
So guys, I don't know if you can hear me or not.
I can.
What do you think we call it a day? Wind.
We just lost you again, Cam.
On then.
Yeah, you broke up, Cam. So maybe I'll take
And then
over.
if anyone wants through emails with the continuing ed points to.
Yep.
Okay.
Okay. Thanks,
Thank you,
Cameron and
Thank
Sean,
you,
for
everybody.
organizing.
Thanks to everyone for.
Be well, everybody. Stay safe. All the best.
Bye-bye.
Wash your hands, stay safe.